Hello and welcome to the Weekend Investing Daily Bite of 23rd of April. The proverbial oot pahad ke niche aana happened today, where the US has sheepishly agreed to not trouble China on tariffs much. At least what the narrative is going now, that Trump is saying that we'll be nice to China and we'll have a deal with China. I think the yields at 4.9% has caused them to lose their the ego that they were having earlier, and realizing that their own markets are getting thrashed like nobody's business while other markets are all going up. So some sense perhaps coming back to the White House. Not sure how long it will last there, but a good news, I think, for overall global markets and just stability of the entire global system that we have. Gold, of course, sell off brutally from $3,500 down to below $3,300 in a flash. And the kind of uh, one way move we have seen on gold, I mean, this was sort of a normal reaction to that. Uh, I don't think the gold rally is over. I think it will consolidate and then start again, because these events, these global events, are not on and off events. Like, I mean, today Trump says this, and tomorrow he says no, I'm good with no tariffs or low tariffs. While that switch may go on and off, countries as a whole have started to look at US in a very different light, and investments in US dollars, investments in US treasuries in a different light, and that will have long term repercussions on how liquidity flows in this world. What are the reserve assets? Which are the safe havens? So, I mean, this 2 months has changed everything, perhaps for the next many years and decades. Even though it may seem like that tariffs were put and tariffs were switched back, and hence nothing has changed, but everything has changed. Let's see locally what happened. So, is the dollar crash coming? Will the market soar? Is the topic of discussion today. We will go back into history and see some very fascinating facts about the US dollar, how it moves and how it impacts the markets. This is a great lesson in the history books about how the dollar impacts the global economy. Disclaimer, please read the disclaimer fully, understand it fully, and do subscribe to the channel. Nifty 0.67% up, despite the way it was, where there was no specific positive news for India. We are overstretched for sure on the very short term. We are looking for some consolidation. Market is not yet stopping. 24,300 on the clock. Nobody's complaining, but this is a fantastic move that is happening. Nifty Junior up 0.69%, nearly 66,000. Mid caps up nearly a percent, 0.98%, to 20,200. Relentless rise in mid caps, 10th day of rise from the bottom. Small caps not so gung ho today, 0.28%. Perhaps most of these markets segments are stretched. They need some consolidation before they can make the next move. Bank Nifty down 0.5% for a change. Bank Nifty also had gone up dramatically from 49,000 to 56,000. New highs, of course, and it may try to come back and retest the breakout at some point. Gold, as I mentioned, coming off is 1.32%. I think gold can come off substantially if it has to correct, perhaps on in Indian rupee terms, maybe somewhere near 90 to 92,000 per 10 grams. That's the kind of correction that can happen. But these are corrections in a bull run, so don't mistake them for making a top and coming back to 60,000. That probably is not happening. 23rd April, 305 advances versus 195 declines. So very much like yesterday, no change in advance decline. HDFC Bank leading the private banks down, State Bank of India leading these public sector banks down. So banking overall was under pressure, probably profit booking. They have seen a lot of gains in the last 9 sessions. And IT coming off in a big way. So TCS 3%, Infosys 3.5%, HCL Tech almost 8%, Wipro 4%, Tech Mahindra 4.5%. Very good moves on IT. So there is a relief rally or U-turn on IT as US starts to uh, open up sort of on the narrative. Bharti Airtel up 1.5%, Tata Motors up 4.6%, Mahindra and Mahindra up 3.5%, Sun Pharma up 2.3%, and rest were range bound. In the Nifty next 50 space, you had DMart, Torrent Pharma, Lodha, Godrej, CP, Britannia. These kind of stocks do well along with TVS Motor. So Harley Davidson duties are likely to become zero. That's the buzz going on. And all the two-wheeler companies in India don't really bother much because they don't make that segment of the motorcycle. Or if they do, I mean, that's hardly any sales for Hero or Eicher, I think. So there is no damage on that front that is happening. Sectoral trends, you can see that IT stocks ruling the day, 4.3% up for the day. For the last 1 week, however, IT is down. IT is up 6.4%. In the last 1 month, IT is down about 4%. So IT is making a comeback uh, in the last 1 month. But if we see on the last yearly basis, it is up only 5%. So in the last 1 year, capital markets, defense, financial services, pharma, and banks. These are the 4 5 sectors that have done well in the last 1 year. But for today, IT stocks, auto stocks, capital market, these three were doing well, and there was some softness in financial services and banks. Some of the IT stocks which gained big today are there in this list, you can see, but the trend still is not a very healthy positive trend. It will still need to consolidate and make a higher high. We are still in a downward trend, but this current leg is looking promising. Let's see how far this goes. 4.3% on the day on the IT index. Now let's talk about the dollar and how our markets are likely to react to this. So let's take a look at the dollar index. The dollar index, as you very well know, is the measure of the dollar versus a basket of currencies. And so far in 2025, dollar index has gone from nearly 110 to about 99. So about a 10% drop in 2025. Now, if we see the last 40 or plus years, significantly you will see there are certain phases where the dollar index was brutally down. So this was phase 1, sort of 1985 to 1992, where dollar index was brutally down. Phase 2 was March, or you can say 2002, Jan 2002 to March 08, where dollar index was brutally down. And we topped out here 2023, and it is starting to come down. This flag also has broken down. This uh, the trend line is about to break down, if it will. And if it does do that, I mean, I don't know how far it will go down, but it does look like this could be the start of the third phase. But of course, it's a speculation at this stage. Let's now look at the first phase, January 85 to August 92. Here, dollar index fell 50% in about 7.5 years. So, from a level of nearly 160, we went down to about 80 in this time frame. And euro was just about starting out at that time. So, the historical backdrop of this was that 1985, the Plaza Accord was made, where G5 nations agreed to weak the overvalued dollar through coordinated forex intervention. So, actually speaking, because the dollar is a reserve currency, from time to time they also need to try and devalue it versus others so that their exports remain cheap for others to buy. But because of something called Triffin's paradox, you can Google it or read it on Grok. What is the Triffin's paradox? It is a paradox where the reserve currency is sort of the reserve currency status is the reason why that particular currency or that country will suffer, because it has to supply all the currency for global trade, and hence domestic interests are undermined. Anyhow, coming back to this, so in 1985, US was able to convince the G5 nations to weaken the dollar versus other currencies. Now, if we were to see today the political discourse, the geopolitical discourse is such that nobody is going to hear anybody. If US tells Europe or Japan or China or Russia today that we are going to devalue our currency, why don't you let your currency appreciate? They are not going to agree. But in 1985, they agreed. So massive USD overvaluation in the early 80s was hurting US exports, and they were able to do this Plaza Accord. And trade partners, especially Japan and Germany, were demanding a weaker dollar to restore competitiveness. So it was followed up with one another accord called Louvre Accord to stabilize currencies and keeping the downward pressure on the dollar. So earlier in that era, countries used to sit together and they were able to figure this out. How to allow US dollar to devalue versus others. When this accord happened, there was a very sharp fall in crude. Um, uh, and subsequently, this was the Gulf War spike. But basically, the spike down happened post this accord. And also during this time period of 85 to 92, while the dollar index was collapsing, Indian market was soaring. So 1985 to 1992, we had a CAGR of 37% on Sensex. The market went up 10x. Uh, so uh, what we basically see, sorry, 1,000%. Market did not go 10x; it went up 1,000%. And what we are seeing is that um, this is not a coincidence that happened. It was basically a culmination of things where India was opening up, and foreign money was coming in as private investments. It started, the FDI started to flow here, and that's where the entire push happened towards that place. So I mean, just look at Sensex levels of nearly 300, went to nearly 3,000, about 10x rise here. Gold in INR terms, 1985, we were sitting at near 135 rupees uh, for 10 grams. It went to nearly 400, 300 or 400 rupees at 10 grams. So CAGR of 13.3%, normal actually. But it was coming on the back of very big moves just very recently in 1977, where 8x kind of move had happened just a few years back. Uh, Equity versus gold in that time frame, 85 to 92, the Sensex was humongous versus gold, of course. And that's where we are in terms of the rupee move. But if we compare Sensex in US dollar terms, it was still doing really well, 416% kind of gain, 24% CAGR in dollar terms also in this phase when the dollar index was falling. S&P 500 at the same time during the same period only delivered 13% CAGR. So Indian markets slash emerging markets did very well in that time frame. The next phase where the dollar index really was sharply down was January 02 to March 08. This is their second phase. We had earlier considered this phase. Now we are considering this phase. In this phase, dollar index fell 40% in about 6 years. What was the backdrop of this period? It was a start of a dollar bear cycle. Following years of strength, markets began pricing in long term US imbalances. There were deficits, US trade and fiscal deficits, so reducing global confidence in the dollar stability. Shifting to risk assets, capital flowed into emerging markets and commodities amidst global growth coming from there. And a commodity super cycle, booming demand for oil, metals, and gold inversely impacted the dollar. So, almost similar setup what we are seeing today, where there is trade and fiscal imbalances hugely in the US. Uh, Capital is ready to flow into emerging markets, commodities, because there's the growth is only available there right now, and a commodities super cycle uh, in metals and gold also awaits. So let's see what happened here. Oil went up 6x during this phase. So oil went from sub $20 to almost $120 in this phase, and this is uh, the biggest risk that exists for these phase three if it happens. BSC Sensex from 2002, if you recall, we were in a flat mode for the entire decade. This was the first cycle, and then the second cycle happened here. 380% return during this cycle, CAGR of 29%. I mean, these are not coincidences that are happening again and again. What happened to gold during this period? 162% up gold during this period, CAGR of 17%. If we compare equity and gold, gold usually has no chance versus equity in such bull runs, and it does not compete with equity. It is always, wanting to uh, provide a hedge or an insurance once equity markets are coming off. So never try to compare equity and gold in terms of which will do better. That is not the purpose of gold. Anyhow, coming back to uh, this in dollar terms, Sensex performed 32% CAGR, while S&P 500 at the same time did only 2.5% CAGR. So you can see that whenever liquidity will move towards emerging markets, they will outperform like crazy, while the local US markets will go flat out, or at least not perform that well. What happened to MSCI Emerging Market Index? You can see 344% was the emerging market index that went up, versus 60% on S&P 500. We are talking about phase two of the dollar decline. So how India benefits from a weakening dollar? So India benefits when the dollar weakens because foreign inflows rise. So global investors rotate to emerging markets. So whenever dollar is weakening, the flows towards India start to rise. So it boosts our equity market, it boosts our bond market, it boosts the rupee. Our NRI friends who are overseas also send more money to India because they feel that their investments in the rest of the world, wherever they are, is not doing as well as what could be doing in India, and that those flows will increase. Of course, it lowers import costs. So cheaper crude metal and electronics reduces input costs. On the flip side, if dollar goes down and crude starts to rally, then these lower import costs because of stronger rupee will get nullified if the oil goes up. Debt relief, dollar denominated debt becomes easier to service because when dollar is cheaper and we have to repay back dollars, it becomes easier for corporates and the government to service those debt. And there's a general macro boost: a stable rupee, lower inflation, current account deficit lowered, improved fiscal math. All that benefits the Indian scenario. Exports, of course, however, are hugely at an advantage. So global demand, higher commodity prices benefit Indian exporters, IT, metals, agriculture, and pharma. And valuation tailwind is there. So relative strength improves in emerging market baskets, triggering a P rating and higher index weights. So MSCI weights and all those things, they start to go up in the India context. So again, coming back to the three phases, we have seen two big phases, and we are contemplating or speculating, is this, we are already in the start of the third phase. These are long phases. It takes 5 years, 7 years for these to play out. uh, is the next 5 years going to be that phase? Is the dollar going to weaken tremendously? Is the emerging market going to benefit out of that tremendously? Is the oil going to go through the roof? Is gold going to go through the roof? Is rupee going to strengthen a bit versus the dollar? All these are questions that are to be asked. But if history has any lessons to teach us, it tells us that whenever dollar index will go down, India will likely do very well. Let me know in the comments what are your thoughts on this subject. What is your thesis on this? I mean, I have presented you my thesis, which could be right or wrong. Only time will tell. But I would love to hear your views as well. Thank you so much for watching this. Do like and share these videos, and do subscribe to the channel. Thanks. Bye.